Welcome to The Explainer. So glad you're joining us today because we are going to completely dismantle a concept that traps, well, almost every beginner out there in the financial markets. Most new investors think of risk as just this one giant generic thing, the chance that a stock goes down. But honestly, that couldn't be further from the truth. If you're treating risk as a single threat, you are leaving your portfolio incredibly vulnerable. So let's just jump right into the source material and build a framework that actually protects your capital. Right off the bat, here's the foundational rule you really need to internalize today. Risk isn't just one thing. It's actually 5 completely different things. Think of them as 5 distinct threats. And here is the absolute kicker. Each one of these threats requires its own very specific defense. Using the wrong defense against the wrong risk? Yeah, that is exactly how highly disciplined investors still manage to lose money. I mean, you wouldn't use an umbrella to protect yourself from a flood, right? The exact same logic applies to your portfolio. To really picture this, imagine your portfolio is a castle. To protect that castle, you need 5 separate walls. Wall 1 is market risk. Wall 2, sector risk. Wall 3, company risk. Wall 4 is liquidity risk. And Wall 5 is geopolitical risk. Just picture different siege weapons attacking your castle from all sides, right? A battering ram, a catapult, maybe a spy infiltrating your ranks, a stuck drawbridge, or even a lightning bolt from totally off the map. You absolutely have to have a specific countermeasure for each one of those attacks. All right, let's get into section 1, defending against market risk. Market risk is basically the threat of the entire market falling all at once. It's that battering ram hitting the front gate. So what's your defense here? Well, you follow the golden rules we covered back in episode 1.2a, and you move your capital into cash when the macroeconomic trend officially turns down. And hey, sitting in cash isn't just doing nothing. It is an active, matched defense mechanism specifically built for market risk. Moving right along to section 2, defending against sector risk. Now, sector risk is a downturn in one specific industry. Think of this one like a catapult, aiming for just one specific tower of your castle. The matched defense you need here is sector rotation, which we went over in episode 3.1. To fight off sector risk, you systematically shift your capital into currently strong groups and get out of the weakening ones before the negative headlines hit. Next up, section 3, defending against company risk. Company risk is sneaky. It's like a spy infiltrating your castle from the inside. We're talking about the threat of a scandal or maybe a massive CEO misstep that tanks one single business. Your defense against this spy? Basket trading, straight from episode 3.1b. Basically, instead of buying one single stock and hoping for the best, you buy a basket of names in that sector. That way, you're never putting all your eggs in one basket. If we put these side by side, notice how perfectly our first 3 threats line up with their precise matched defenses. Market risk, countered by cash. Sector risk, countered by rotation. Company risk, countered by basket trading. You see, the generic advice you always hear to just diversify more is honestly functionally useless unless you are matching the exact defense mechanism to the precise risk type. Because if you try to use basket trading to fight market risk, you are still going to lose your shirt when the whole market crashes. Which leads us to section 4, the diversification illusion. This brings us perfectly to a critical insight that most beginners completely miss. True diversification isn't just one broad skill. It's actually several separate skills stacked together. Let's look at a real-world example from our source material. Picture an investor in 2022 holding a portfolio made up of 10 different technology stocks, just 10 equal slices of a pie. That investor probably looked at their account and thought, wow, I own 10 completely different companies. I'm incredibly well diversified. But here's the reality check. 10 tech stocks absolutely does not equal a diversified portfolio. Why? Because they're all in one sector. When rising interest rates totally crushed the technology sector in 2022, all 10 of those stocks fell together. This investor had beautifully executed company risk protection. If one tech CEO failed, they still had 9 others, but they had absolutely 0 sector risk protection. A sector-wide event took down the whole shebang. So remember, true diversification requires spreading your capital across sectors, not just across tickers within a single sector. Okay, let's pause for a second. I want to test this logic to make sure we're on the same page. Quick check. Let's say you own 10 different regional bank stocks, genuinely 10 separate, distinct tickers. Suddenly, a regional banking crisis hits the news. Were you diversified against this risk? Take a second and think about what wall of the castle is actually being attacked here. Got your answer? The answer is absolutely not. You had company protection because you owned 10 different tickers, meaning if one specific bank made a bad loan, you'd be fine. But you had zero sector protection because a banking crisis attacks the entire industry all at once. True sector protection means you have to own stocks completely outside of banking, ensuring that a localized fire doesn't burn down your entire portfolio. So, the really crucial takeaway here is this. Confusing company risk with sector risk is exactly how seemingly disciplined, well-intentioned investors get caught flat-footed in a crisis. They think they've built all 5 walls of their castle, but in reality, they just built one really, really thick wall and left the other 4 sides completely exposed to attack. All right, let's take a look at where you stand right now. You have successfully lit up 3 of your 5 castle walls. You now understand market risk, sector risk, and company risk, and you know their exact matched defenses. You can literally look at any portfolio now and tell if it just looks diversified by ticker count or if it is actually fortified by sector and market exposure. But notice, 2 walls remain unlit. Which brings us to section 5, the final 2 risks. In part 2 of this explainer, we are going to light up those final 2 walls of our castle. We'll uncover liquidity risk, which is the danger of not being able to exit a trade when you really need to, and geopolitical risk, where we'll learn how to trace the second and third order effects of global shocks rather than just reacting blindly to the headlines. But before we wrap up part 1, I want to leave you with a final provocative thought. Beyond identifying these 5 risks, do you know the single, non-negotiable mathematical rule that should govern every single trade you ever place in the market? It is a strict 3-to-1 reward to risk ratio. If a trade doesn't pass it, you just don't take it. No exceptions. We're going to break down exactly how to calculate that in part 2. Thanks so much for hanging out with me to explore this incredibly powerful framework. I cannot wait to see you in the next explainer to finish building our castle.